Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. Hello, I'm Michael Bull. Thanks for being with us no matter where you're catching us around the country or around the world. We appreciate you being with us. This segment is brought to you by Barnes Creative Studios. If you need a video for your project, check out barnescreativestudios.com. They do incredible work. Well, today we're talking about the office market. You know, some of the third quarter numbers are starting to come out, and I think people are always curious about the office market because there's so many things seemingly impacting the office market today. We have still companies trying to use less square footage per person. We have people working at home. We have companies wanting more flexibility. We have changes in the economy and the way people work and how they get to work. So let's see what's happening in the office market. Please welcome my first guest, Barbara Denham. She is senior economist with Reis, and she's joining us on the phone. Barbara, thanks for being with us.
Thank you for having me.
So how is the office market performing today?
You know, the office market is doing very well. Nothing staggering. The vacancy rate stayed flat at 16.1% in the third quarter, which is no change from the second quarter, and in fact, it's no change for the last year. So we've had this very flattening of vacancy, and rent growth was actually pretty low too. It only increased 0.3% for the quarter and only 1.5% year over year. So office rents have been very flat, and the vacancy rate has been flat as well, which is odd in that we're so deep into this expansion and we have very healthy job growth, but we're just not seeing the drops in vacancy that we have in previous cycles.
Well, that's interesting. And is that because of new supply? What's causing it?
Well, I think it's a combination. Believe it or not, supply growth has not been too aggressive, unlike the apartment market where we're seeing tremendous construction across the U.S. I think developers really got burned in the last expansion, more so even than housing construction or apartment construction. So developers have not been overbuilding, and net absorption has been okay, but again, we're just not seeing these robust occupancy growth levels. I think, like what you just mentioned, many people have been offered opportunities to work from home, so companies have been very conservative about how much square footage they lease, and that's having a tremendous impact on the overall growth in the office occupancy rate.
Yeah, it's interesting. You know, but people can work at home, good for them. I remember working at home at one point, and I had one of the biggest calls in my career. And as the guy's talking to me and telling me that I won this job, this assignment that I was going to be doing, it was a real catalyst to my career at the time, and I was a very young man. Well, my dog was standing next to me, and if anyone walked down the sidewalk, this dog was going to start just really barking. And I thought, what's this guy going to think when he hears my dog start barking? How can people work at home? Well, you talked about rents being flat. You talked about occupancy being flat with rents just only increasing slightly. Is that different for the different classes, though, Barbara? Is Class A maybe improving a little better, or what do you see?
No, I think it's the same across the board. We don't have the breakout yet, class by class, but we're seeing another, like, again, that's another kind of equilibrium measure. Which is, they're both, occupancy in both Class A and Class BC are growing at the same steady pace, but we're only building new construction. No one builds Class BC office product. So let me see. Historically, I'm seeing like the vacancy rates in both markets very, very flat change. So like the Class A is just about 16.0%, and Class B is similar, about 17%. So not much of a difference between Class A and Class BC.
And when you look at the office sector historically, where does this number put us?
Well, so I was just writing about this. You know, in the height of the 2005 2003 to 2007 expansion, vacancy rate fell to 12.3%. So this is very, very different. To fall to 12.3%, whereas today it's really persistently stalling at 16.0, 16.1%. The same vacancy rate, we've had the same vacancy rate for 7 quarters now, 16.1, 16.0, 7 quarters in a row. So you can really feel this sense of equilibrium, and we're probably not going to get that much further below, say, 15.8% over the next year or two. So it's just a different paradigm in this expansion.
Yeah, it's a little bit slower growth, isn't it? But we've had job growth. We've had expansion. We've had businesses are doing well, but I guess they're just they're
just cramming more people into smaller spaces.
Yeah.
All those millennials in that like little open office space. I guess it's good for the overall economy because it's keeping rents lower, but it's probably not great for landlords.
Yeah. Well, Barbara, if you will, look into your crystal ball there. I think we sent you the Commercial Real Estate Show's crystal ball. Did you get that in the UPS delivery? What do you expect moving forward for next year or the closeout the year next year for office performance?
Well, one thing I should mention is we're seeing a pretty big gap between the good markets and the bad markets. And I don't mean to label some markets bad, but some are seeing vacancy rate declines. For example, markets like Memphis and Greenville and Indianapolis saw vacancy rates increase. Even markets like San Jose saw a vacancy rate increase. Whereas on the other end, markets like San Francisco, Louisville, and Atlanta doing pretty well, seeing drops in vacancy rates and very strong, much stronger rent growth than other markets. So like markets in your area, Charlotte, Nashville, and Atlanta all seeing very strong rent growth in terms of like 0.5% to 1% over the last quarter. Whereas at the bottom, markets like San Diego, New Haven, Chicago, and Pittsburgh recording a loss. I think this kind of gap between the good markets and the bad markets probably will widen. I can tell you even in Atlanta, job growth, office-based job growth in Atlanta was very strong this past summer, growing by 5.9%. That's the second highest job growth rate in office jobs in the country. So I think everything is in very, very good shape. I think we will see more very, very slight declines in the vacancy rate going forward, but some markets like New York, where we actually have the lowest vacancy rate, 8.6%, we are seeing a lot of construction. So some markets are doing well, but you're seeing a little bit more office construction than others. So I think all in all, we're going to see a continuation of this pattern. I think vacancy rate will fall below 16.0%, hopefully as low as maybe 15.6, 15.5%, which is better than today, but still not that strong relative to previous expansions. And rent growth should be in the 2% to 2.5% in the next year, I believe, going forward. But overall, the economy is very strong. So I think the overall good news is it's clearer to tenants looking to lease space. They're not going to see aggressive rent growth, nor are they going to see any rent declines in most markets. So they can kind of look towards the future with a lot more certainty than they would have in the past.
Right, and that's good if you're running a business, and maybe good if you're loaning on some of this commercial real estate or investing to know what to expect. I was interviewed by a reporter the other day about the Atlanta market where our headquarters is located, and they were asking me about the difference between suburban and urban office space. What do you see in your numbers as you look at the country overall, the difference in performance there?
Well, the good news is the suburban markets have improved a little bit more in the last 6 quarters than they had been. In the beginning of this expansion, it was all central business district, urban core. That's where so much of the growth was because that's where so many of the millennials and people, many big tenants wanted to be. There was kind of a flight to quality in that, in the downturn, rents fell, and so many tenants who wanted to expand, they chose to expand in the CBD or Central Business District, where they could secure a good lease. Now, later in this expansion, we're seeing the suburban markets pick up. So now they're kind of, again, at equilibrium in that suburban markets are doing almost as well as the central business districts are.
Okay. And I think it'd be interesting to hear from you, Barbara, about the cap rates that you're seeing, the trends there, what you expect moving forward. We're going to take a quick break. We'll be right back, and we'll have Barbara Denham. We'll talk about the cap rates, what to expect moving forward. Stay with us. I'm Michael Bull, and this is America's Commercial Real Estate Show.